Hey, so smart investing is paramount in today's world. And let's be honest, there's too many speculators and online influencers who make it look easy, but let's face it, it's not. So I decided to go old school. I picked up a classic book called The Intelligent Investor, written by the mentor of the greatest investor of our time, Warren Buffett. And today I wanted to share with you the timeless lessons I learned from the book. I think lessons that can help you invest smarter, definitely avoid costly mistakes, and make sure that you're building real wealth and doing it the right way. Enjoy the episode. I think you will love it. Practice owners, tired of working hard but not seeing the financial results you deserve? I'm Eric Miller, and my best-selling book, How to Become a Financial Beast, is your game changer. Learn how to maximize profits, pay yourself right, and build wealth outside your practice. Download now for free. Hey, welcome back to the Financial Beast podcast. I'm your host, your BFFF, best financial friend forever, Eric Miller. Welcome back. For those of you that don't know who we are Econologics financial advisors. We offer premier financial advice for practice owners and associates. And really what we do is simple. We show you how to acquire money, control money, and invest money so that you can own your own life and live the life that you want to live financially. Check us out at econologicsfinancialadvisors.com. And as always, if you would give us a like or a share or a comment, subscribe on the podcast, that would be helpful as well. As you guys can see, I'm going at it alone today. So I usually have a guest, or I usually have Eric Gershon with me, but he's out of town and I don't have a guest this week. So you know what? You guys just get me this week, and that's okay, because I've always wanted to do this just to, I don't know, just pontificate or go over a subject that I've been reading on. I think a lot of the clients that we have, or a lot of listeners that we have in general, you come to this podcast because you know that we specialize in working in your industry. We understand the healthcare industry, and we understand how that integrates the success or failure of how you do in your profession or in your practice is going to have dramatic impact on your household. And you can't separate those two. So, it's our job to make sure that you are putting your household number one, putting your household number one. So many people don't do that because they just think that the practice is so much more important than the household. But actually, they need to marry each other in many different ways. And that's primarily what we talk about on this channel, is to make sure that you're taking care of your household, financially speaking. So that's number one. I've also been reading quite a bit on just like different topics as they come along. And one book I've been reading here recently that I want to talk about today is what's called The Intelligent Investor. Now, many of you may have heard this book. Most of you probably have never heard this book before. It was written a long time ago. It was written by a man named Benjamin Graham. And if that name even kind of rings a bell or anything like that, you would probably hear that name muttered from who's probably regarded as the world's greatest investor, Warren Buffett. That was Warren Buffett's mentor. And Warren Buffett, oftentimes you will hear reference Benjamin Graham as a person that taught him about investing, taught him about stock selection, taught him about just a basic philosophy of how to invest your money so that you have success, which I think everyone's trying to do. Like, we want to make sure that when we position our money somewhere, we have success. It's going to look different because now it's going to be like immediate success. And success to people looks a lot different nowadays. I mean, just 20 years ago, financial success was like, gosh, if I'm getting like a 7 to 8% return on my money, man, I'm pretty happy with that on an average return. Now it's like, I feel like I'm behind. A lot of people are like, fear of missing out on, what they see people making just, thousands of percent return on certain things. And, when things get crazy like that, I always try to go back to like basics and make sure that there's not a flaw
that we missed, or, hey, is it different this time? And we've heard that many times. You will find that the buzzwords of today become buzz saws on your portfolio, because a lot of the people that are promoting certain things or saying that you're going to be able to get uh, returns that are above and beyond what you would probably normally expect, those usually end up badly. But that being said, I just wanted to go over some lessons that I've learned from this book that I thought were important, that I want to make sure that a lot of you are listening to, and at least when you are looking at your investments and your investment strategy, even if you're not a client of ours or if you are a client of ours, that these lessons, I think, put some perspective on how we look at, or what our philosophy is, and more importantly, how you are managing your own assets as well. It's a very long book. It's like 500 pages. I'm halfway through right now, so I only have 7 lessons that I'm going to go through today. And I may not even go through all of them, depending on how long I pontificate on a couple of these. But I want to go over some of these lessons because they're powerful. And again, we're living in a bit of a crazy world right now where, what used to be yellow is now blue, and what used to be blue is now yellow, or just things aren't always aligning the way that they did in the past. But that doesn't mean that basic principles can't be applied. That doesn't mean that these lessons aren't valuable to you. I can assure you these lessons are not going to be, I need you to buy X amount of this stock or X amount of that stock, or sell this or sell that, or put all your money in this or that. It's not going to be that. These are going to be very simple lessons that I think, if you're building a bedrock of how to be a successful investor, which all of you do, all you want to be, and you all are investors, by the way, like every single one of you that owns a practice, even those that don't own a practice, but have a household that you're managing. Your household's a business, just like your practice is. And you want to be successful at investing. Everybody does. So I'm going to go over these lessons, and let me know what you guys think as we go through them. Any comments on that? I'd appreciate that. Lesson number 1, and I thought this was a great way to start off because it really resonated with me the first time that I read it. And I'm going to paraphrase it. It's not taking a quote out of the book, but it's important to not only have an investment strategy, but an investment policy. Now, you may be thinking, oh, what's the difference of that? So let me give you an example of like an investment strategy. So for us, here's how we typically will position a client, or here's how we'll work with a practice owner. First and foremost, your practice is the wealth building engine, but it is not more important than your household. What I mean by that is that we need to set up a strategy in which a portion of the practice profits are transferring systematically and automatically to your household. And that's a strategy that we have. We call it our wealth building blueprint. If you want to connect with us, we'll certainly, we do webinars. We have, just have a ton of things online that you can reference to. And I'm sure we talk about our wealth building strategy as well. But the strategy, okay, what is the strategy? Okay, because I see a lot of balance sheets for practice owners. I just looked at one yesterday. And, I see someone that has, so they own their practice. They own a percentage of their building. They have money in $10,000 in I bonds. They have, like 3 different personal checking accounts. They have a Roth, a traditional. They have, some VULs that somebody, sold them. And I'm looking at it, I'm all like, this person doesn't have any idea what they're doing. They're just doing what they think they need to be doing. There's no strategy here. Okay. There's no strategy of where their money, as it comes in, it's going to help them get to a place where they have multiple income streams, where they have some prediction of what their income is going to be, 10, 15, 20 years down the line. They had no clue. It was just, hey, this guy said we should do this and we did this. Hey, we put money in our simple, or we have this is, they had no clue. You could just tell by looking at least I could. So having an investment strategy is important. Okay. Now, like I said, investment strategy would be for us would be, okay, I need to start separating out your profits. So we have you set up a separate account. We call it the wealth storage account. And then that money that's being diverted from the business to that wealth storage account then is used to buy certain types of investments. And again, in our strategy, it's usually a combination of, marketable securities, stocks and bonds, and, for capital appreciation, for income. We use insurance-based products for guaranteed income and protection of assets. And then we look at alternatives like real estate or, some other private types of investments, again, for potentially income, capital appreciation, to beat inflation, all these kinds of things. But it's a strategy, right? We set certain amounts. We kind of take the temperature of the investor, like what does he like? What do they like? And then put that strategy in place. That is a strategy. You know where your money is going before it comes in. That's what a strategy does. Okay. If you don't know that, you don't have a strategy. A policy is a rule. It's a guideline. It is saying that these are things that we're going to do. These are things that we're not going to do. And if you look at any big institution, if you look at any large endowment fund, be it Harvard, be it an Ivy League school, be it a state-run pension fund, whatever it would be, you're going to find that all of them have an investment policy statement of some kind. And we have this in our plans as well. And they're just a list of rules. These are things that we're going to do. These are the types of eligible investments that we have. These are things that we're not going to do. Okay. One rule would be I'm not going to sell out my portfolio when the market takes a 20 or 30% decline. Like that's a rule. It's a guideline. We're not going to do that. We're not going to react to what the quote unquote market prices are indicating at that point in time. We're not going to lend money to people that can't pay us back and have no means to pay us back. Like that's a bad idea. Okay. I'm not going to invest in something just because the return says so. That's a terrible way to invest money. Okay. So you need to have an investment policy. And this is where a lot of people just get in trouble because we've had people that have just poured money in, someone comes along with here's a beautiful, pro forma sheet that shows this investment and this is what it's going to do. And here's historically how it's done. And, there's no other nuance to it. It's just, and, you need to trust me and that's it. And, people have lost a lot of money. Give you an example. People that bought a ton of real estate in 2022 when interest rates were low. Interest rates went up in 2023. A lot of these real estate operators have had to go belly up. And, I've had clients that have lost hundreds of thousands of dollars, if not millions. Now, again, I didn't recommend them. I probably should have been stronger on telling them this is a bad idea. But, sometimes, people just have to have their own experience in things and kind of learn the lesson the hard way, unfortunately. But I think that is a lesson. You need to not only have a strategy, but have a policy of things that you're going to do and you're not going to do. Makes it very simple. When you talk with your spouse about these are the guidelines that we have and these are the things we're going to do and we're not going to do. Okay, that's lesson one. Okay, lesson number two. The value of any investment must be a function of the price that you pay for it. Value of any investment is always and must be a function of the price that you pay for it. Okay. What does that mean? Well, I think it means what it means. You have to be cognizant of the price that you're paying for something. A great example of this, I think, was, back in the 90s. I'm a child of the 90s. So, I loved basketball and, I watched, of course, all the, Larry Bird, Michael Jordan, all those guys. Although in 1996 or 7, I think it was, they paid Michael Jordan $30 million a year to play basketball, 30 million, which was 6 times, maybe 7 times, maybe 10 times more than the other guys. And it made sense because he was the best by far. Okay. And he brought in the most money. He brought in the most eyeballs. He brought in, you know, so much revenue. So why didn't they pay him 100 million? Why didn't they pay him 200 million? Okay. They paid him 30 million because that was a fair price. And that was a fair investment price for his services based upon what he brings. The point is, guys, is that not every investment that you see out there is a good investment if you have to pay too much for it. Okay. So always be cognizant of that. Now, if you're going to acquire real estate, if you're going to acquire a practice, okay, make sure that you understand that concept. Like, I'm not just going to pay something because you think that it's worth this much. Okay. It's only a good investment to you based upon the price that you pay for it and what's the upside. So always remember that when you're looking at investing in something or buying something, especially an investment that that you're getting into. Okay, lesson number 3. And this is really important for those of you that are thinking about exiting and are looking at, what do I do with the sale proceeds? How do I invest the sale proceeds? And it goes like this. The more the investor depends upon his portfolio and the income from it, the more necessary it is to guard against the unexpected and disconcerting in this part of his life. Said another way, if you are in a position right now where you are dependent upon your investments to pay for your lifestyle, if you are dependent upon the income from those investments to utilize that cash flow to pay for your lifestyle, then the more necessary it is to guard against anything that could be unexpected, anything that could put stress in your life. Now, does that mean that you move all of your money to bonds or money markets or cash or gold and silver or whatever? No. You just need to make sure that you understand the difference between being a speculator and a defensive investor. Okay. And a speculator, of course, is someone that is only buying something for the price. They don't care about anything else. They don't care about the value of the investment. All they want to do is buy something and they want to see the price go up. That's it. Okay. Or down if they're, playing options or the short game or whatever it would be. But if you're an investor and you depend upon the income from your portfolio, you 100% want to make sure that you're guarding against that. Now, how do we do that? Well, one of the ways we do that is we simply say, okay, we need to make sure that we own different types of investments where some of this is going to be money that is going to be used to appreciate, to kind of fight against the inflation that is going to occur. Some of this is going to be money that we want to make sure is returned to you in some way, whether that's guaranteed income or just residual income of some kind, or could be tax-free income that where you don't have to pay tax on that. It's another thing you have to be cognizant of as well. But the point is that you need to make sure that that you are. Well, I'll get to that in the next lesson, I think, or one of the next lessons. Is that you don't have a closed mind when it comes to different types of investments. And so many people do. They have so many opinions out there about, this type of investment or that type of investment. And I think the more money that you have, especially when you sell your practice and you get, $2, $3, $5, $6, $7 million, you can't think the same way that you did as when you owned it. Okay. You have to take a different approach. And that's really important that you have that approach. But again, you don't want to have stress. And you want to make sure that you have dependable income coming in that can pay for your lifestyle. I think that is of primary importance for anyone. Okay, lesson number 4. I like this one. Buying something for its yield is like getting married only for looks. Now, there's another way I could have said that, but I'm going to keep it clean, folks. Buying something for its yield is like getting married only for the looks. So, again, how many times do we have to have someone come to us either upset about the returns that they're getting or coming to us with an investment that said, well, look at this investment. It yields 10% or 15% or 25%. And I'm like, and that's the only reason that you're buying it? And they're like, well, yeah, I need to beat the inflation rate. It's like, dude, you're going to get killed at some point in time. You will get killed if that's what you're going to do. Because who's to say that the returns are going to be consistent that way in the future? You, me, Buffett, Santa Claus has no idea what the future of stock prices are going to be. We don't know. You don't know what the future of real estate prices are going to be. We don't know. Okay. Nobody does. I'm sorry. They don't. And you shouldn't invest like that. And if you're investing like that, then shame on you. And you're going to get burned because of that. So you need to make sure that when you're looking at an investment, number one, it's a true investment. Number two, you figure out, number one, is this in alignment with my overall strategy? Number, three, is this part of my investment policy? Is this an eligible investment? How much am I going to dedicate to this investment? What are the inherent risks of this investment? What are, what kind of investment is it? Is it something that, is going to be important in 5 years or 10 years? I think the best advice I've always seen is that, you want to buy important companies that are profitable. Okay. And that's not always the case. I mean, you'll see, companies out there that have grown exponentially. They're not profitable at all. They're not going to last. They may last for a short period of time, but they're not going to last forever. Sooner or later, it will catch up. And if you're not paying attention to that, then that's going to have a dramatic impact on your portfolio. So just don't buy something just because someone promises you a yield. Inspect it, understand the underlying investment, its story. Is it in alignment with your philosophy? Does it make sense to you? Who's operating it? All these different things that you would need to ask yourself. But please don't come to us and just say, I'm buying this because the return is blank. It's a terrible way to invest money. And it is an indicator of someone that is a rookie. Quite frankly, I hate to be that brutal about it, but it's a rookie move. That's what we see. Number 5, the great successes of life are made by concentration. So here's a little hint to you. And I'm sure you guys have heard the buzzword of you need to be diversified. There's an element of truth to that. It's just when you need to worry about diversification is the point. Now, for most of you that own a practice, own your real estate, when we look at your net worth statements and we break down like the percentage of your practice value and your real estate value to your overall net worth, I would say 80 to 90% of owners have 70 to 80% of their net worth tied up in their practice and their real estate. And there's nothing wrong with that. That's what I'm talking about. You have a chance for a great success because you're concentrated, and you should be, because if you look at the potential value of some of these practices now, if you run a really good ship, if you are profitable, if you have multiple practitioners, if you're in a good area, if you can stabilize your people, if you have no legal or compliance issues, it's not unusual for me to see, 7, 8, 12, even 15 times earnings that these practices are worth, which is amazing. That wasn't like that 15 years ago. So, think about that. If I have a $3 million revenue business that's doing 20%, that's a $600,000 EBITDA, that potentially could sell for anywhere between, 5 million and 5 million to $7 million. It's amazing. Okay. That's what I'm talking about. The great successes of life are made in concentration. You're concentrating in an area. Okay. Now, at what point do you diversify? Well, you diversify when you become dependent upon the proceeds of the practice sale. That is when you need to start looking at diversification. Okay. Now, in the meantime, we do like to make sure that you're building other income sources while you own the practice. That's why we have you take that 10% out every single week. That's why we have you invest, so that we can create some alternative income sources. But make no mistake, okay, when you sell your practice, it should be an event that, probably should fund maybe 40 to 50% of your retirement. It's a big amount. Okay. So, that's what I want you guys to concentrate on. Like that is of much higher importance than worrying about the yield that you're getting on a money market fund. Okay. Or, what your Roth IRA is doing that has $9,000 in it. You see what I mean? Like, there's so many important things that will move the needle for you guys. And yet we tend to get like, really, you get your focus on really things that aren't important, and I hate to say it that way, but they're just not. Like, if you're not taking 10% of your practice revenue out to pay yourself for your household, if you're not accelerating getting your personal debt paid off, if you're not trying to get your practice in a condition where it's really, really valuable and profitable, then those are the things that are important. Okay. Some of these other things are just not important. Let people like us kind of direct you on the things that will help you, really get you where you want to go. But remember that the great success of life is made by concentration. So we concentrate early on, and then we slowly, especially when you're getting closer to transitioning out, we'll worry about diversification at that point in time. Okay, 2 more lessons. Lesson number 6. This is kind of a long one, but stay with me. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transferring his basic advantage into a basic disadvantage. The one advantage that you have, if you are going to own marketable securities, if you're going to own stocks and you're going to own, bonds, anything that are public securities, okay, is your basic advantage is that when you see the aberration of investors, when you see the market declines or the reaction to bad news, your only advantage is that you can either join the masses or you can say, I'm not going to partake in that craziness. And I'm going to use my basic advantage, which is your patience and your plan and trusting in your strategy and trusting in the companies that you own. Because, I saw this last in the spring, we saw companies that shaved 40 to 50% of their value because people were worried about tariffs and everything like that. Were there anything wrong with those companies? Were those companies unprofitable? Were those companies have trouble with management? No, there's the day-to-day operations of those companies did not change one bit at all. Okay. But you could have made a decision. You could have bought them, you could have bought Tesla when it was at 200. Now it's at 400 again. Okay. You could have bought it at half price. People didn't. Why? Because, they turned their basic advantage, which is your patience and your logic, into a disadvantage, which is, you were distrusting, you were, whatever terms you want to use, you turned it into a disadvantage. So that's a really key point because we are going to have declines again. We absolutely will. And, people are saying there's going to be a huge crash. Okay, great. There probably will be. So are you prepared for that? Like, do you have all of your assets in places that are going to be materially affected by a crash in the stock market? I mean, if you do, shame on you. You shouldn't have that. Okay. Like I said, your concentration right now should be in your practice, in the practice building, if you can get it. And then we have other investments where we do include marketable securities, but they shouldn't be a huge percentage of your overall net worth at this point in time. So, but But people obviously have been told that's the only place that you can put your money to exceed the inflation rate. And again, I'm not anti stocks and bonds at all. I look at it from a household perspective. How much of that do we want that to be a part of the overall household portfolio? And that's the strategy. But most importantly, if we have hundreds of millions of dollars of clients' assets in stocks and bonds, but we also try to make sure they understand, like, look, this is part of a strategy here. And we're not going to react when everybody gets crazy, because that would be crazy. And we don't want to do that. Okay. Last lesson. And I think this is one of the most important lessons I read in the whole book. No one's gravestone read, he beat the S&P 500. And I thought that was pretty funny. Like, if all you are concerned about is beating the market, friends, I need you to get a life. I need you to find something that's more purposeful. Spend more time with your family. Talk with your patients more. That's what's important. The outcomes that you give, the outcomes that you have on your family, the outcomes that you see in your practice and your staff and your employees. It's not, oh, my portfolio beat the S&P 500. Okay. No one cares about that. Our job as financial advisors is to make sure that you are managing your household resources correctly. It's not to beat the S&P 500 every single year. Okay. And if that's the only thing that's important to you, then I think you need to prioritize things in your life, because it's not. And sure, we want to get good investment returns, but I'm not looking for excessive investment returns. I'm not looking for, we want to get adequate returns, making sure that you're investing in smart investments, in good companies that are profitable, or good products that are going to pay you back your money at some point in time. And it's okay to take risk. It's okay to speculate. It's okay to buy things that, you guys, think are going to be valuable at some point in time. But you also have to ask yourself, am I speculating or am I investing? And most of the time people are speculating when they think that they're investing. Okay. And, you see it right now, obviously, in the crypto markets, where people are, the only thing that you can hope for is that someone is willing to pay more for this investment than what you paid for it at this point. I'm not knocking it. I'm not saying, I even own a little bit of crypto, but I certainly don't put that as a bedrock of a portfolio, because I'm not really sure what the overall proposition is at this point in time. I've read books on it. And I guess I'm not there yet. I haven't invested a ton of time to really understand it that well, but there are different ways in which you guys can make money. You don't have to try to quote unquote get ahead by doing something over speculative and putting yourself at risk. But those are the lessons I've learned. I hope those are helpful. I'm going to share more of those as I continue to read the book. And I hope you guys have a really happy investment experience. And again, if you need help, please reach out to us. And we can certainly do a portfolio review, do a household investment review, do a review of all your assets, all your investments, your practice, looking at your practice finances. We can help you with all of that. So make sure that you guys reach out to us, and we'll be more than happy to do that for you. Okay? Be well, guys.